Assalamualaikum to Dr. Mukris. My name is Nurul Atira binti Muhammad Rudin, number metric 298650. So today I will explain about the answer I got in quiz 3 finance. So for the first question answer, appreciation happens when the value of currency increases compared to another. For example, if one Australian dollar used to be 3 ringgit 20 cent, but now it's only 2 ringgit 90 cent. The Malaysian ringgit has appreciated. This means we need less ringgit to buy Australian dollar, so it's cheaper for Malaysian to travel to Australia or buy Australian products. On the other hand, depreciation means the currency becomes weaker. Let's say 1 Australian dollar used to be 3 ringgit 20 cent, but now it costs 3 ringgit 60 cent. That means the ringgit has depreciated. Malaysians now need to spend more ringgit to get the same amount of Australian dollar, making it more expensive to travel or import goods from Australia. So appreciation makes foreign goods and travel cheaper, while depreciation makes them more expensive but may help local exporters. Okay, now let's look at question 2 answers, the difference between nominal exchange rate and real exchange rate. Nominal exchange rate is the rate at which one currency can be exchanged for another. It reflects the market rate without adjusting for inflation. For example, 1 US dollar equals to 4 ringgit 70 cent. On the other hand, real exchange rate adjusts the nominal rate for differences in price levels, which is inflation, between two countries. It shows the actual purchasing power of one currency relative to another. Okay, now let's look the example on how real exchange rate can depreciate stable or appreciating nominal rate. So let's say 1 year ago, 1 US dollar equal to 4 ringgit 70 cent, but today 1 US dollar equal to 4 ringgit 95 cent. So RM slightly appreciates, but in the same period, Malaysia inflation is equal to 6% and US inflation equal to 2%. Although the nominal exchange rate shows a small appreciation, Malaysian goods have become relatively cheaper in real terms because prices in Malaysia have increased more slowly. Now the real exchange rate depreciates, meaning Malaysia's exports become cheaper and more attractive internationally, even though the nominal rate stays stable or appreciated slightly. Now for the question 3, the difference between the spot market and the forward market in foreign exchange. The spot market is where currency is exchanged immediately, usually within 2 days at the current market rate. It's useful when you need to make a payment right away. While the forward market, on the other hand, allows you to lock in an exchange rate today for currency transaction that will happen in the future. It's mainly used to hedge against the risks of exchange rate changes. For example, imagine a Malaysian manufacturing company is importing machinery from the US worth 500,000 US dollar, and payment is due in 3 months. Right now, the exchange rate is 1 US dollar equal to 4 ringgit 70, but the company is worried that in 3 months the rate might rise to 4 ringgit 90, which would make the machinery cost 100,000 ringgit more. To avoid this risk, the company uses the forward market to lock in today's rate of 4 ringgit 70. That way, they will know exactly how much they will pay in ringgit, regardless of what happens to the exchange rate. So they will choose the forward market over waiting for the spot market to protect themselves from currency risk and keep their budgeting accurate. Now for question 4, let's look how we calculate the real exchange rate or RER between Malaysia and Japan. We use this formula, which is RER equal to nominal exchange rate multiplied with Malaysia CPI divided with Japan CPI. This formula adjusts the nominal exchange rate by considering inflation differences between the two countries. So, in the initial period, the nominal exchange rate is 3 ringgit 80 cent per 100 Japanese yen. Malaysia's CPI is 105 and Japan's CPI is 100. So the RER is 3.99. In the final period, the nominal exchange rate slightly drops to 3 ringgit 60. Malaysia's CPI rises to 110, while Japan's CPI rises only to 102. So now the RER is 3.88. This drop in RER from 3.99 to 3.88 shows that Malaysian goods have became relatively cheaper compared to Japan, even though the ringgit slightly appreciated nominally. In simple terms, this real depreciation means that Malaysia's trade competitiveness has improved. Our products are more attractive to foreign buyers, and that can boost exports to Japan. Okay, now let's look at question 6 answer. So option 1, invest locally at 2% return on 150,000 ringgit will give us 153,000 ringgit, while for the option 2, we invest in the UK by start converting ringgit to pounds at today's rate of 5 ringgit point 50 cent per GBP. And we get GBP 27,272.73. Then we invest it at 3.2% in the UK and we get GBP 28,145.45. Now we convert it back to ringgit using the expected future exchange rate of 5 ringgit 30 cents per GBP and we get 149,171.89. And the final comparison, local return give us 153,000 ringgit while the UK return give us 149,171.89. In conclusion, although the UK offers a higher interest rate, the appreciation of the ringgit from 5 ringgit 50 cent to 5 ringgit 30 cent reduce the final return. So the better option is to invest in Malaysia. Okay, now for question 7. When we talk about forward contracts and foreign exchange, we are referring to agreements to buy or sell a currency at a specific rate on a future date. So what is the difference between a long and a short forward position? A long forward position means you agree to buy foreign currency in the future, while a short forward position means you agree to sell foreign currency in the future. Now let's look at both examples. Example of a long position. Imagine a Malaysia business importing goods from the UK. It needs to pay in British pounds in 3 months from now. But what if the pound strengthens later? That would make the payment more expensive in ringgit. To protect itself, the company takes a long forward position, which means it agrees now to buy GBP at 5 ringgit 40 cent per pound in 3 months. This lock in the exchange rate and eliminate the risk of a rising pound. Other than that, for example of a short position, we imagine a Malaysian exporter selling products to the UK. The buyers will pay them in pounds in 3 months. The exporter is worried that the pound might weaken, reducing the RM value of the payment. So they take a short forward position, which means they agree to sell GBP at 5 ringgit 40 cent in 3 months. This way, they lock in the RM value and avoid losses from a falling pound. In conclusion, go long if you are buying foreign currency in the future, and go short if you are selling foreign currency in the future. Both strategies are used to manage exchange rate risk. So now let's look at question 8. In this question, we are asked to calculate whether the Malaysian ringgit is trading at a premium or discount against the Australian dollar based on spot and forward rates. We are given spot rate equal to 3 ringgit per AUD and 9-month forward rate is 3 ringgit 5 cent per AUD. We use the formula for the analyzed forward premium or discount, which is in bracket forward rate minus spot rate divided with spot rate close bracket. Multiply with 12 divide numbers of months, multiply 100. And we substituting and calculate the values and we get 2.22%. Since the forward rate is higher than the spot rate, this means the Australian dollar is expected to strengthen, or in other words, the ringgit is trading at a discount in the forward market. So the annualized forward premium is 2.22% and the ringgit Malaysia is at a discount. Now let's look at question 11. A Malaysian exporter expects to receive 100,000 euro in 6 months. They have two choices. First, lock in a forward rate of 5 ringgit 8 cent per euro, and second, bid and convert using the expected future spot rate of 5 ringgit 20 cent per euro. So let's calculate both. With a forward contract, we got 508,000 ringgit. Using the expected spot rate, we got 520,000 ringgit. So by locking in the forward rate, the exporter would receive 4,000 ringgit less than if they waited and used the expected spot rate. So in this case, not using the forward contract would be more profitable, assuming the expected spot rate of 5 ringgit 20 cents turns out to be accurate. However, forward contracts are still useful when the company wants to avoid uncertainty or protect against unfavorable currency movements. So for question 13, in international economics, there are two important versions of purchasing power parity, which is absolute and relative. First, absolute purchasing power parity. This theory says that identical goods should cost the same in different countries when prices are converted into common currency. For example, if a basket of goods costs 100 ringgit in Malaysia and the same basket costs 20 US dollar in the US, then the exchange rate should be 5 ringgit per USD. This is based on what's called the law of one price. However, in reality, transport costs, taxes, and trade barriers makes this less practical. Second, relative purchasing power parity. This version is more realistic. It doesn't assume prices are exactly equal, but focuses on changes over time. It says that if one country's inflation is higher, its currency should depreciate to maintain parity. So if Malaysia has 5% inflation and the US has 2%, we expect the ringgit to depreciate by about 3% against the USD. Okay, now let's look at the main difference. So the main difference is absolute purchasing power parity compares price levels directly, while relative purchasing power parity compares changes in price levels or inflation differences. So in conclusion, absolute PPP gives us a theoretical exchange rate today, while relative PPP helps us understand how exchange rates might move in the future due to inflation. Next, question 16. Let's check if absolute purchasing power parity holds in this case using laptop prices from Malaysia and the US. In Malaysia, the laptop costs 4,500 ringgit. In the US, the same laptop costs 1,000 US dollar. The current exchange rate is 4 ringgit 60 cent per USD. Okay, first we calculate the implied exchange rate by using the formula, and we got 4 ringgit 50 cent per USD, and then compare implied rate and actual rate. We got implied rate is equal to 4 ringgit 50 cent and actual rate equal to 4 ringgit 60 cent. Since the actual exchange rate is higher, FPPPP doesn't help. In conclusion, the laptop is relatively cheaper in Malaysia than it should be if absolute purchasing power parity help. This means the ringgit is slightly undervalued compared to the USD based on this product. Next, question 17. In this case, we are comparing the price of a book in the UK and the US to see if arbitrage is possible using absolute purchasing power parity. UK price is equal to £40 and US price equal to 60 US dollar. Current exchange rate is equal to £1 equal to 1.40 US dollar. First, we calculate the implied exchange rate, which is the no arbitrage rate, and we got 1.50 US dollar per pound, but the actual rate is only 1.40 per pound, which is lower than the PPP suggests. This means the book is cheaper in the UK when converted to dollars. We could buy it for £40, which equals 56 US dollar at the current exchange rate. Sell it in the US for $60 and we get profit $4 per book. In conclusion, there is an arbitrage opportunity because absolute purchasing power parity doesn't hold, and the price difference can be exploited for profit. Now let's look at the question 20. Let's check if there is an arbitrage opportunity with a jacket sold in Switzerland and the US. In Switzerland, the jacket costs 100 Swiss francs. In the US, it costs 90 US dollar and the current exchange rate is 1 Swiss francs equal to 0.85 US dollar. So using absolute purchasing power parity, we calculate the no arbitrage exchange rate and we got 0.90 dollar per Swiss francs. But the market rate is $0.85 per Swiss francs, which is lower. So the jacket is cheaper in Switzerland. We could buy it in Switzerland for 100 Swiss francs equal to 85 US dollar, and we sell it in the US for 90 US dollar and make a 5 US dollar profit per unit. In conclusion, arbitrage does exist, and the exchange rate will need to be 0.90 US dollar per Swiss francs to eliminate the opportunity. Okay, now next question, 22. The ringgit Malaysia per Japanese yen exchange rate is determined by the interaction of demand and supply for Japanese yen in the foreign exchange market. Malaysians demand Japanese yen to import goods from Japan, travel, or invest there. So when these activities increase, the demand for Japanese yen rises, shifting the demand curve to the right and causing the yen to appreciate against the ringgit. Meanwhile, Japanese firms or investors supply yen in exchange for ringgit to purchase Malaysian goods or invest in Malaysia. When the supply increases, the supply curve shifts rightward, leading to a depreciation of the yen. The exchange rate reaches equilibrium when the quantity of yen demanded equals the quantity supplied. This equilibrium is shown on this graph as the point where the demand and supply curves intersect, determining the market clearing ringgit Malaysia per Japanese yen exchange rate. Next question is 24. To estimate the expected future spot exchange rate between the Malaysian ringgit and the British pound using the uncovered interest parity theory, we apply the UIP formula, which is UIP equal to current spot rate multiplied with, in bracket, 1 plus Malaysia interest rate divided with 1 plus UK interest rate. Now we substituting and calculating into the formula, we get 5 ringgit 20 cent. This result suggests that according to UIP, the ringgit is expected to appreciate slightly against the pound over the next year because Malaysia has a lower interest rate than the UK. Now for the last question, question 27. We start with the Fisher equation, which connects the nominal interest rate with the real interest rate and expected inflation. For Malaysia, our home country, we say IM is approximately equal to RM plus pi m. For the foreign country, for example, the United States, IF is approximately equal to RF plus pi f. This means that the nominal interest rate includes both the real return and expected inflation. Now let's look at the relative purchasing power parity. According to relative purchasing power parity, the expected change in the exchange rate depends on the difference in inflation rates. We express it as E of ST plus 1 minus ST over ST is approximately equal to pi m minus pi f. This means if Malaysia's inflation is higher than the US, then the ringgit is expected to depreciate against the US dollar. Next, we apply uncovered interest parity. UIP tells us the expected change in the exchange rate is equal to the interest rate difference between countries. We express it as E of ST plus 1 minus ST over ST is approximately equal to IM minus IF. This implies investors expect to earn the same return whether they invest in domestic or foreign assets, assuming no arbitrage. Since both relative purchasing power parity and uncovered interest parity predict the same thing, the expected change in the exchange rate, we can set them equal. So, IM minus IF is approximately equal to pi m minus pi f. Now substitute the Fisher equations into this. So we say Rm plus pi m minus Rf plus pi f is approximately equal to pi m minus pi f. And we simplify it and we get Rm minus Rf is approximately equal to 0. Therefore, we conclude Rm equals to Rf. That's the real interest parity condition. This means, in the long run, real interest rates should be equal across countries if capital markets are open and there is no arbitrage. So, any difference in nominal interest rate must be due to differences in inflation. That's all for me. Thank you.